welcome to a fresh episode of Legal Wrangle on income tax. We have selected 3 important cases. First, where Assessee has made mockery of benevolence shown by the revenue. Second, where IT department has withdrawn registration of a trust solely on the ground of an amendment in the trust deed. And third, where benefit of exemption under section 54 was denied on the premise that construction of new property was commenced prior to purchase of a new residential house. The Assessee in this case, that is the Indian Institute of Logistics, is an educational institution providing undergraduate and postgraduate courses in logistics and shipping. It landed into trouble because of its negligent and sluggish approach towards the compliance of a huge outstanding dues payable. Now let's understand what exactly happened in this case. The Assessee, when expressed its inability towards depositing the tax dues, the revenue permitted it to clear the outstanding in monthly installments. The Assessee, however, without considering the nicety of the offer made by the department, even failed to stick to the installment scheme. This prompted the department to initiate prosecution against the Assessee by imposing interest for the belated payment as per section 201.
The final outcome of High Court. When revenue has shown benevolence in granting payment of tax dues in installments, if the Assessee misses installments, it is a fit case for launching prosecution.
Now let's move on to our second case, where the action of restoring the registration of the Assessee trust under section 12A was challenged. Now let's understand what exactly happened in this case. Coming to the background of the case, the department had noticed that as a result of an amendment in trust deed, the absolute control over the management and conducting the activities of the trust was handed over to the chief trustee for all times to come, thereby barring the public from access to properties, funds of the trust. This led to the misconception that Assessee was no longer a charitable body, and it resulted in withdrawal of registration granted to it under section 12A. However, when this was challenged before the tribunal, the registration was restored.
Let's see what was the final outcome by High Court. Change in future management of the trust is no basis to take away its registration under section 12A. Here are the key takeaways. Number 1. Cancellation of registration of trust under section 12AA is only in 2 contingencies. 1. The objectives of the trust are not the genuine, or the trust is not being carried out in accordance with the objects of the trust. Secondly, the amendment not being in the spirit of charitable trust cannot be the basis of cancellation under section 12AA, as the term spirit of a charitable trust is neither defined in the Act nor elaborated in the order of the CIT. Therefore, amendment of trust deed or change in the management of trust is no basis for cancellation of registration granted to the trust under section 12A when its charitable nature remains untouched.
Now let's move on to our last case, where the Assessee was denied benefit of section 54 on the premise that investment made by the Assessee towards new residential property was not within the period of 3 years from the date of transfer of old res identical property. The circumstances which led to the formation of such opinion was that no allotment or agreement was made within the stipulated period of 1 year from the date of sale of the old property, and further no substantial payment were made towards the cost of the new asset. Now let's understand what was the opinion of CIT on this issue. The first appellate authority opined that the amount of capital gain not utilized for construction of new house up to the due date of filing of return under section 139 should have been deposited in the notified capital gain account scheme before filing of the return of the income, which was however not complied with by the Assessee.
Now let's see what the tribunal finally decided. Inception of construction of new residential property even before transfer of existing one will not debar investor from seeking benefit of section 54. Key takeaways. Provision of section 54 does not prescribe any condition as to the date of commencement of construction of house property, which may be commenced even before the date of transfer of original receipt. Second, the construction of house property may be commenced even before the date of transfer of original asset However, it should be completed within 3 years after the date of transfer of original asset. Thirdly, formation of construction agreement prior to transfer of old property is no basis to deny benefit of exemption under section 54 if construction was completed within 3 years from date of transfer of old residential property.
With this, we wrap up this episode of Legal Wrangle. Next time, we will bring you some more interesting cases. Thank you for watching. Goodbye.